You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm Brian Overby, the author of the Options Playbook, and I'll be your host for about the next 10 minutes here on Options Playbook Radio. And with Options Playbook Radio, we're going to change things up a little bit. Whenever I see something that is inspiring to me and I want to talk about it, I'm going to grab my recorder and try to come up with a trade. And a lot of times it'll be centered around a known event. It might just be the fact that I saw something in a chart that I like. But with that said, I'm going to make that recording, send it off to the great people over at the Options Insider, and we're going to turn that into a podcast. And well, this week we have a Fed meeting. So because of that, I want to do a trade centered around that Fed meeting. It's going to be this Wednesday. We're taping Options Playbook Radio. The markets are just about to close. It is Monday, September 15th. And the underlying that I'd like to trade in today is GLD, which is the ETF that tracks gold prices. GLD just set a new all-time high. It actually touched $339.28 today, and then it is now came off a little bit, and it's currently trading at $338.75. It's up over 3% on the day. And we're also seeing implied volatility creep up a little bit, probably because of the Fed meeting. And we're seeing that in the marketplace too. We have the S&P 500 index up today, but we also see the VIX index up, which is counterintuitive. Usually if the VIX is up, that means that the markets are down. But it's not uncommon for that to happen around a Fed meeting. So as far as the Fed meeting is concerned, it's highly anticipated, according to the Fed Watch tool over at the CME, that the Fed will be cutting at least a quarter point at this meeting. They might even cut, there's a 5% chance that they might do 50 basis points. And then at the next meeting, right now there's about a 77% chance that they're going to do another quarter point. So with all that said, there's just, for the first time in a while, there's going to be a lot of question marks at the Fed meeting that are sure going to get addressed in the conference call after the meeting. And so with that said, let's take advantage of some of that volatility and go out and do what I like to call an open wing butterfly in gold and lean bearish with it. So with GLD at $338.75, we're going to use the Friday expiration, which is the 19th. We're going to buy the 345 strike put. We're going to sell 2 of the 339 strike puts, and then stop short from a standard butterfly, and we're going to buy 1 of the 337 strike puts. Now, that makes this an open wing butterfly. The midpoint for this butterfly, based off the prices right now, is $3. That means that your max risk would be $300 per 1x2x1 spread that is executed. The max reward would also be $300, which is found by looking at the width of the long spread, which in this butterfly is from 345 down to 339. That's the middle stripe. And that's 6 points wide. And if we can execute at the midpoint, now don't forget you got to put in fees and commissions and all that good stuff with it. If we could execute at that midpoint, we'd be paying $3 for it, and the maximum we could sell it for would be $6. So our max reward would be $3 if the market went right to 339 and it stopped there. And that's where it finished this Friday. Now, like I said, we're going to stop short on the short spread, and this is what makes it, in my mind, an open wing butterfly, in that the short spread in the butterfly is not as wide as the long spread. The long spread is 6 points wide, the short spread is only 2 points wide. That means that if the market does go below $337, that this open wing butterfly would still be trading for right around $4, which is the difference between the widths of the spreads. 6 minus 2 equals 4, and that's what the butterfly could trade for if it was below $337, which is the lowest strike put in the butterfly. All right, now by opening up that wing, you're going to pay a little bit more up front, but now you're really directional, right? And the only way that we're going to actually lose on this position is if the market goes up. If the market stays where it's at, we're fine. If the market drifts down, we're fine. If the market really goes down, we're fine. The break-even point is figured by taking the highest strike, which is the 345 strike put, and subtracting the net debit paid. So if we executed it at $3, it means that we would be at $342. So anywhere below $342, this trade could be profitable heading into this Friday's expiration date. And as I said, it would take another all-time high in gold in order for this trade to become unprofitable, and the 345 strike put at this point in time has a delta fairly close to 20, so there's only about a 20% chance based off of the delta that at expiration that GLD could trade at least 1 cent above the 345 strike put. All right, so that is a speculative trade, and I say it's mainly speculative because it's such a short-term trade, trying to take advantage of the pumped-up implied volatility that has been created in these option contracts, mainly because of the Fed meeting that's happening this week. We're trying to take advantage of the fact that that gold has had a very strong move to the upside and might be a little bit exhausted, and maybe after the Fed meeting, we could either see gold just meander around where our middle strike is at, or go lower. And that's basically our outlook for putting this trade together. All right, that's it for this episode of Options Playbook Radio. Please click subscribe at whatever service you're using to listen to Options Playbook Radio, and we'll see you next week for the next edition of Options Playbook Radio. Thanks for tuning in.
You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play.